Okay, in today's video I'm going to explain in a little bit more detail what we went over in the off the chart segment on Mad Money yesterday, and hopefully it'll give you a better understanding of what I'm looking at here. So I'm going to start with the weekly chart of S&P Cash and just a couple things to go over. One of the reasons why we were looking for a possible low back here in December had a lot to do with simple time symmetry, where we had a couple of prior declines over here that were 14 weeks and 14 weeks, and we were exactly 14 weeks down as we kissed the 200 simple moving average. And then there was also a retracement ratio of one of these major swings. It wasn't the larger swing, but I think it was one of these internal swings. So you had that going on, and at the same time back then I did have some daily cycles that came due when this low was made. So we had a couple of different things going on that suggested that we might see a low. So when we did start to see a bit of a rally, we had to look at it this way. Well, we don't know if this is going to be a more important low, but if it is, your potential upside target is typically going to be the 1272 extension of the swing into the zone, which means that we still have a higher target at 3102. But I'm not going to tell you that I'm going to look for this market to continue straight up in the same degree of trend that it has been and head towards that target. And of course, I could be wrong about it eventually meeting the target. But what I'm kind of looking at is that we may see a bit of a pullback to the December lows and then a resumption of the rally. That I'm looking at as far as a possibility. But I'm not seeing that that's going to happen just yet. So let's first talk about cycles. Anytime that the market is going straight up into a grouping of cycles, you want to anticipate a possible reversal of whatever the trend is. So since the trend was up, we're going to look for a possible reversal back down. The only problem with this is that this is a very wide time window, because we're talking about the weeks ending March 22nd through April 5th. All right, and then you add plus or minus a week in that, and it's a very, very wide zone. But that's not all the information that we have. We have this general information that says, hey, you better ratchet up stops and protect profits just in case, because there is resistance to the current rally. This is what else I saw, and this was the histogram that I did on the Dynamic Trader program, which was created by my mentor Robert Miner. And what I did was I projected the timing from the last low for the next possible high, and that came in between the dates of March 20th through March 22nd. You can see those are the highest scoring dates, and this is what it looks like with the actual histogram. And you can actually look in here, and this will show you the cycles that are coming due at that time. So when we had the confluence of timing cycles for a possible high, again, you wanted to anticipate a high, but this wasn't a large time window. This was the 20th through the 22nd, and then you could say plus or minus a day, which would mean that the 19th and the 23rd would also be within the time window. But that's a more reasonable, time window to look at for a possible reversal. Now, if you go back to the daily chart in S&P, you'll see that, we actually had an extension of this prior swing, and many moves do tend to terminate at extensions of prior swings. So you see that we met the minimum target at that 2842 area, and then we almost got towards the second target. We also had a projection of this prior rally swing projected from this low that kind of capped the high. These two swings were pretty similar. Okay, so we had resistance and we were extended, where moves tend to terminate, and you had the timing cycles. So that's why, I was like, well, we're extended and we're in a place in time where you could get a reversal. But even though we did get a nice, healthy reversal, these are the next things that you have to look at. At this moment in time, this market's still okay in the bigger picture, because look at these prior swings. This most recent decline has only been 2 trading days from the high if you count the first bar as 0. So this is 2 days from the high. This decline was 4 days. This decline was 3 days. This decline was 2 days. This decline was 3 days. They were very short-lived, these pullbacks within this gorgeous uptrend. So far, the same pattern's intact because this is only 2 down. When would I start to worry? Well, if we started declining for much more than 5 trading days down from the new high, that would get me a little bit concerned. When else would I get concerned? Well, if you look at all these prior rally swings, you'll see that one of these swings was very similar to the other. So this high to low was $76.31. This high to low so far is $75.29. Okay, so very similar in price. All I know is that I don't want to see it go down from any new high for more than $94.61. I mean, obviously, not exactly, but let's say it starts going $97, $98 from a new high. That starts to concern me also. What else would concern me? Well, if it took out this prior swing low, the one that was made on March 8th. Okay. And what else? Well, right now you're clearly above the 200 simple, and you're above the 50. If we started breaking down below those, I would be concerned. Okay. And that would be time to, get on the sidelines or whatever if those things start to occur. Now, as far as one more thing, I do use a 513 EMA crossover on my daily charts to kind of help you stay on the right track. And first I'm going to show you that a while back when I had the timing in September, back here, here's where you had the 513 EMA crossover to the downside. That was, a very quick signal that showed you that we were vulnerable to the downside. Okay, so I don't use the 513 really by itself for like a trade setup, but I like to be on the right side of it, for example. So in this case, after we had made that key low in December, after the 14 weeks down, you had the 513 cross back over to the upside here, okay, and you'd rather be on the side of this. If the 5's above the 13, you'd rather be on the buy side. If the 5's below the 13, you'd rather be on the sell side. That's basically a general statement. But here, we're still looking at the 5 being above the 13. So has it crossed over to the downside yet? No. But if that occurs, okay, I get concerned. And, I'll back off the buy side until, it looks good again. So what else do you need to know? Well, I do want to show you an example in Apple with that 513 combo. So, check this out. It doesn't work in all the stocks like this, but it has worked extremely well in the case of Apple. So in October, when we made this high and then you had the crossover to the downside, notice that it stayed that way until right over here. Okay, so if you just said, well, I'm only going to trade Apple on the side of this, then you wouldn't have been looking at the buy side until over here. Okay, and since then, you haven't seen it cross back to the downside yet. So again, it's just one piece of information. It's one tool. It's not something that you're necessarily going to create a trading plan with. Obviously I like to use time, price, and then triggers for trade entries, but it's something that can be extremely helpful. One last thing that I will tell you, and this concerns me. The market hasn't really broken down in a big way, but the fact that we had timing at this last high, which I showed you that histogram, and this high was actually made on the 21st, I believe. Okay, yeah, this is actually a 30-minute chart in S&P cash. So it made the high here, and in the process of trading down to a support decision where we had started to see a bounce, we took out this prior swing low. And because we had timing and we also took out a prior swing low, and you also at that time had the moving average cross over to the downside, you always want to watch the next pullback for a possible failure. And we were not able to clear this pullback zone. So that's what tells me that, you know, even though the daily chart still looks okay at the moment, the lower time frame charts are definitely putting out some warning signals there. Okay, for this to look good again, we would need to continue to hold above here and then take out this resistance to consider that we might get back on track for new highs. Okay, and if we don't, then don't forget the scenario is for, you know, maybe a deeper downside correction back to the December lows. Okay, so that's something to think about. I hope what I showed you makes some sense. I mean, if you have any questions, you could always ask me, but I'm not sure how many questions I can answer on Twitter, but I'll try.